Your bank is earning about 4% on the money sitting in your savings account. It's paying you 0.01. That's not a typo, and it's not illegal. It's the single most profitable trick in modern banking. It happens in plain sight, and the data proving it is published by the government every 3 months. Once you understand how it works, you'll never look at your own bank statement the same way again. Here's the mechanic underneath everything a bank does. You deposit money. The bank doesn't just hold it in a vault, it lends that same money out to home buyers, to businesses, to other banks at a much higher interest rate than it pays you. The gap between what the bank earns on your money and what it pays you to hold it has a name: net interest margin. It is, quite literally, the core of how most banks make money. And right now, that gap is enormous. As of 2026, the Federal Reserve's benchmark rate sits somewhere around 3.6%. Banks can park your deposited cash at the Fed itself and earn roughly 3.75% on it, risk-free, doing absolutely nothing. Meanwhile, the average savings account in the country pays about 0.6%, and the biggest national banks often pay as little as 0.01. Sit with what that means. A bank can take your money, lend it back to the economy, or simply hold it at the Fed, earn several percent on it, and hand you almost none of that return. The difference doesn't disappear into thin air. It becomes profit, reported proudly to shareholders, built substantially on the fact that you didn't move your money. Now here's the question that actually matters. If online banks and credit unions are paying 4 to 5% on the exact same kind of savings account, why does anyone still earn 0.01% at a big bank? The answer is uncomfortable, and it has a name too. It's called the loyalty tax. Banks don't set your savings rate based on how long you've been a customer, or how loyal you've been, or how much you deserve. They set it based on one cold calculation: how many people will stay no matter what. If a bank knows that, say, 95% of the people in a given savings account will never move their money, regardless of the rate, then there is zero business reason to pay them more. Raising the rate would just cost the bank money without keeping a single extra customer. So they don't. Your loyalty, your inertia, is exactly what makes paying you almost nothing the rational choice. And this leads to something genuinely strange. In banking, being a loyal, long-term customer often earns you a worse deal than being a brand new one. New customers have to be won with promotional rates and bonuses. Existing customers are, in the bank's own internal math, already captured. The reward for trusting your bank for a decade can quietly be the worst rate they offer to anyone. And banks understand human behavior better than most people understand their own finances. They know that moving your money feels like a chore. It means opening a new account, moving direct deposits, updating auto payments. Most people look at that hassle, decide it's not worth it for a little extra interest, and stay. That decision, multiplied across millions of customers, is worth a fortune. Let's put a real number on that inertia. Someone with $50,000 sitting in a big bank savings account paying 0.01% instead of a high-yield account paying around 4.5% is giving up roughly $2,245 a year, every year, for nothing. That figure comes straight from public federal banking data, not from some savings app trying to sell you something. And because interest compounds, that gap doesn't just repeat, it widens. Over 5 years, the difference between a big bank account and a high-yield one on the same starting balance can run into thousands of dollars of pure, avoidable loss. Money that quietly became your bank's profit instead of your savings. It gets worse once you factor in inflation. Money sitting in a 0.01% account isn't just failing to grow, it's actively losing value every year because prices rise faster than that account will ever pay you. On a $25,000 balance, the difference between a big bank rate and a top high-yield rate can swing your real purchasing power by nearly $6,000 over 5 years. One account quietly loses ground to inflation, the other actually stays ahead of it. Same money, same risk, same government-backed insurance, wildly different outcome. Here's another layer most people never notice. When the Federal Reserve raises rates, banks are quick to raise the rates they charge borrowers on mortgages, credit cards, and loans.
But they raise the rates they pay you far more slowly,
if at all. Analysts even have a term for how much of a rate change gets passed on to you: deposit beta. When the Fed hikes, the bank's lending income jumps immediately, while your savings rate crawls up, sometimes by a fraction, sometimes not at all. The spread widens, and the bank keeps the difference. Rate cuts, on the other hand, get passed on to your savings almost instantly, fast to take, slow to give. Between 2021 and 2024, the Fed raised its benchmark rate from near zero to more than 5%. During that entire stretch, the national average savings rate never even climbed above 0.5%. The Fed handed banks a huge increase to work with, and almost none of it reached ordinary savers. To be fair, there's a legitimate reason big banks pay less than online ones. Traditional banks carry the cost of physical branches, tellers, real estate, and security. Federal data suggests brick-and-mortar banks spend roughly 4.5% of their deposits on branch-related costs, while online-only banks spend less than 1%. Those savings are part of why online banks can pay you so much more. So some of the gap is real cost, but not all of it. A physical branch explains paying somewhat less. It does not explain paying 100 times less. The distance between 0.01% and 4% is far too wide to be justified by rent and tellers alone. The rest is simply margin the bank keeps because it can. And you might wonder why competition doesn't just fix this. If online banks pay so much more, why don't the big banks lose all their deposits? The answer is that the biggest banks simply don't need your savings the way a small bank does. They have enormous, cheap pools of deposits from customers who will never leave, plus access to other funding sources.
They can afford to pay you almost nothing,
precisely because they're big enough not to have to compete for you at all. And banks rarely make it easy to notice. Your low rate is disclosed technically, buried in fine print and account terms most people never read. There's no letter in the mail saying you could be earning 400 times more somewhere else. The information is public, but the effort to act on it is entirely on you, and banks are counting on you not to. None of this requires anything illegal or even hidden. It's just a system where your inertia is a revenue stream, and where the most profitable customer is the one who never checks whether they're getting a fair deal. So the real takeaway isn't that banks are evil. It's that a savings account is not a favor your bank is doing you. It's a product, priced against your likelihood of doing nothing.
The single most powerful thing you can do about it
costs about 10 minutes. Check what your money is actually earning and compare it to what the same money with the same federal insurance could earn somewhere else. Because the gap between those two numbers isn't an accident and it isn't a mystery. It's the business model. And right now, for millions of people, it's quietly working exactly as designed. Subscribe to keep learning how the money you already have actually gets used and who profits from it.